Welcome. I'm so excited to see you all here for this year's investment briefing. This is an incredibly important discussion. I'm really glad that you're here. I'm Rebecca Fishman-Lipsey, President and CEO of the Miami Foundation. Again, we are building the home base for philanthropy and social impact in Miami. We take that charge very seriously. We house at this time nearly $500 million of charitable assets that we safeguard and invest and grow to strengthen Miami. That is our community's war chest. We lean on that if there's a hurricane. We lean on that when there's a pandemic, when there's a housing crisis, when we see mental health challenges rising for our youth. It's money from this generation of Miami leaders, from last generation's promise to us, and it's our promise that we make to our kids and future generations as well. Last year alone, together, we invested $70 million back into our community. Some of that was endowed dollars that we have built over decades, and some of that was new money that we brought into Miami from national partners, from local partners. A lot of that was you stepping up for our community, giving to the priorities that you care about. We have two major jobs. Job number one is to steer every penny that we have towards the greatest possible impact, to know every nonprofit, every grassroots leader, every need, and to bring people together to solve problems more boldly with each other than they could by themselves in silos. Our other job is the brilliant management of the money that we house, to invest it, to safeguard it, to grow it as a precious resource for our community, which means that every year we're able to give more to our community in Miami. And that means, of course, that we are paying really close attention to the market and advising you, our fund holders and our partners, about what you can be doing to have the greatest impact now and the greatest impact later by investing smartly, both when times are good and when times are not. Today, you're going to hear from some of our most trusted advisors. And so I'll leave you with just three thoughts. Thought number one, when the market is hurting, the needs go up in our community. We are in positions of great privilege to be analyzing how to maximize our assets in this moment, and we have a great responsibility to step up for our community even more in moments of pain. Thought number two is, if you can't give more, give better. Inflation is leading to spiking costs for our nonprofits. We estimate approximately 15%. It costs 15% more for your favorite nonprofits to do the same good work that they were doing last year that you were supporting them to do. And if you can't give them 15% more this year, I encourage you to consider at least unrestricting your dollars so that they can leverage your resources more to do what they believe is best and not feel trapped by the way that they are given resources. And the third thought for you is to leverage for-profit principles. The reason that we're hosting this event and bringing our investment experts here today is to make sure that you treat your philanthropic assets with the same care that you would any other asset in your portfolio. These are precious dollars, both for you and for our community. And we want to make sure that you're able to make wise choices for the money that you invest and the money that you draw down for our community. We are transparent. We partner with outstanding wealth managers, and we take this part of our work incredibly seriously. And with that, I am excited to pass the mic to our incredible host for today, who's a good friend, Estrella Sibilla, who's a brilliant attorney, one of our Miami Fellow alumni, and she is going to introduce our panelists for today.
Thank you so much, Rebecca, and thank you everyone for joining us for today's discussion. My name is Estrella Sibilla. I'm the founder of Sibilla Law. We're a boutique real estate and land development firm in Coral Gables, celebrating our 10th year this year. I've been involved with the Miami Foundation, started like most of you as a small donor and a volunteer. Eventually that led into my participation with the Miami Fellows program, and that's really where I fell in love with just the work, the passion, and really the goal that the foundation centers all of their planning and giving around. My involvement with the fellows led to establishing a fund at the foundation. Through that fund, we've been able to raise and give more than $250,000 in the 10 years that we've been around. And it gives me great pride to be able to share this stage with such great folks that are also deeply involved with the foundation and are leading us and leading you in ways to further our dollars, further our impact, and further our investments. With that being said, I'd love to go ahead and start to introduce our panelists. With me today, we have Julie Naso, who's our foundation board chair, Sheldon Anderson, our foundation vice chair, Glenn Harris, who serves as our external CIO, Mr. Bill Jarvis, and Ms. Erin Knight, who's our foundation investment committee chair. And with that, I'd like to start with some self-introductions, and perhaps we can start with Ms. Julie Neitzel.
Good afternoon, everybody.
You are muted.
Good afternoon, everybody. Having slight technical difficulties.
So let me go ahead and, Julie, let's move to Sheldon for a moment. And Mr. Sheldon Anderson, perhaps you can take the lead and start with our introductions and give us a nice briefing of your participation with the foundation and a little bit more about yourself for those who may have not had the pleasure of meeting you just yet.
Thank you very much, and welcome everyone. I'm Sheldon Anderson, Chairman and CEO of Grove Bank and Trust. I've been with the foundation for a couple of years now, and as was said earlier, I serve today as Vice Chair. Happy to be with you this afternoon. Thank you.
And introduce yourself.
Well, good afternoon, everyone. My name is Glenn Harris. I am the investment officer and relationship manager for the Miami Foundation's investments. I've had the pleasure of working with the foundation staff, the board, the committee, and all of its partners for nearly 10 years now. I've got an extensive background working with nonprofit organizations, especially community foundations, serving this marketplace for more than 25 years. I look forward to our conversation this afternoon. Thank you.
Excellent, thank you. Bill, did you want to go next?
Certainly. Good afternoon, everyone. I'm Bill Jarvis with Bank of America. I had thought leadership here in our philanthropy group, 200 people serving endowments and foundations, including community foundations, many in the Miami area. I've been doing this work like Glenn for about 20 years, primarily as an educator. Many of you will know me as the creator of the major studies of endowment investing for the National Association of College and University Business Officers, the so-called Kubo study, Council on Foundations, and other studies. Here at the bank, I'm the same guy. I am the editor of our study of philanthropy, which we conduct every couple of years with the Indiana University Lilly Family School, a study of what wealthy people give to and why, something that we'll be talking about later on. So very happy to be here today and to be with this group.
We're definitely looking forward to your commentary on the trends in giving and looking forward to seeing more details on that. Erin, did you want to go ahead and introduce yourself, or Julie, were you able to get our connection back up and perfected?
Tell me if you can hear me now, Estrellita.
Perfect.
Thank you, thank you. There's always a workaround solution, and I really apologize to everybody for my tech difficulties, but I'm Julie Neitzel. This is actually my 6th year on the board of trustees for the Miami Foundation, which has been an amazing experience. I'm very honored to be leading the board of trustees. My professional background is I have been working with wealthy individuals and families for several decades. A lot of the work that I've done with them has been around philanthropy, as well as planning for the next generation and investment activities. So I think everything we're going to talk about here today is not only highly relevant on my end, but to each and every one of you. And thank you for your support in being here.
Thank you so much for that. And Erin, let's get a little bit of information from you, and then I'll go ahead and turn it over to you so that you can sort of lead the charge with this first segment. So welcome, Erin.
Thank you very much, Erin Knight. I've been with the Miami Foundation since 2020, and my career, I've spent time in private and commercial banking, like my colleague Sheldon on the investment committee. And I currently head a firm, Monument Capital Management, which is a real estate private equity firm. And I'm delighted to have all of my committee members and our panelists here today.
Thank you so much for that introduction, Erin. We were getting ready to start the discussion today with the state of the foundation. Can you lead us into that discussion and give us a brief of how we're doing at the foundation and some of the highlights?
Absolutely. We've called today's discussion resilient strategies for turbulent times. And I'd like to share an overview of the framework with which the investment committee works. And we manage donor and nonprofit funds. As Rebecca said, this is something that we take very seriously. And as this fiduciary, it's now more than ever running through our minds. And we as the investment committee, our responsibilities include setting our investment distribution and policy guidelines. We develop the investment objectives and performance measurement standards, which are consistent with the needs of the foundation. We determine the asset allocation and rebalancing strategies to meet the foundation's objectives. We also select investment advisors, who then in turn select our investment managers and custodians. And on an ongoing basis, we review and evaluate our investment results in the context of predetermined performance standards, benchmarks, and we implement corrective action as needed. So that's a bit about what our committee does. And I will share each of our committee members with you. And we're proud to say that we feel that the investment committee represents the community as a whole in terms of diversification of the membership. We have Hispanic, African American, female. So we have a diversity of background, but also diversity and expertise within each member's, what they bring to the table from their day jobs, if you will. So I've already introduced myself. We have Ben Beavers, who is also an attorney. He's foundation board member and treasurer, and he's the chairman and foundation of Gresham Sustainable Wealth Management. And he has 40 years of experience working in wealth advisory. Kareem Brantley, who's a chartered financial analyst, foundation board member, and founding principal of the Integral Group. Tony Argiz, a CPA, foundation board member, and also the managing partner for South Florida for BDO. Christina Hudson, she's a certified financial planner. She's ex officio investment committee member, managing director and special advisor at Field Point Private. Eric Zeitlin, also ex officio investment committee member. He's CEO of PWA, managing director, RJFS financial advisor, Province Wealth Advisors, and Julio Con, also ex officio member, who's director and finance chair for the Knight Foundation. So we have selected a group of members who really have investment experience themselves and diversification. Next, I'd like to share with you a bit about our investment policy statement, which is just before these investment options. But, high points, we work within an investment policy, and that creates a framework for which the investment committee can evaluate the performance and explore new opportunities, make recommendations to enhance the portfolio. And I would say highlights, key important words to us are diversification, balance, oversight, portfolio, having a portfolio that has uncorrelated returns from various asset classes. And then you'll hear more about the specific results from Glenn Harris a bit later and how our results have compared to the benchmarks. So within the funds that we manage, the goal is to give donors an option of customized investment approaches that would fit their goals and in the hands of a trusted investment advisor. So within the pools, we've got a long-term pool, and that would be a horizon of 10 years or more, seeking a consistent stream of returns, lower year-to-year volatility, and the greatest long-term impact for a donor. A balanced pool with a 5 to 10 year horizon, moderate risk adjusted returns, emphasis on total returns through the investment strategy. A bit shorter, the income pool, 1 to 3 investment horizon, 1 to 3 year, with low to moderate risk adjusted returns, emphasis on total returns through its investment strategy. Social impact pool, 7 to 10 years or more, with focus on sustainable long-term financial return, investing primarily in equity and fixed income securities of public companies that effectively and prudently govern with respect to their impact on the environment, business practices and contribution to local communities and promotion of diversity and equality in the workplace. The index pool, 7 to 10 years or more, with a simplified and traditional portfolio with a broad market asset class such as US and international equities, investment grade fixed income. And then the cash pool, the shortest term, less than 1 year, the goal of preservation of principal and high degree of liquidity for current income and meet any short-term grant making needs. How do we receive gifts? So we receive gifts in many different ways, and we continue to evaluate how we receive gifts. And what I didn't mention earlier is that we also evaluate our investment policy statement on a regular basis and our outsourced chief investment officer. And the last full review we did by an external firm of the chief investment officer was in 2018. So we receive, as I said, cash, checks, credit cards, ACH, wires, stocks, and then most recently, we amended the policy to accept cryptocurrencies, specifically Bitcoin and Ethereum. We also have received gifts of real estate, art, illiquid business holdings, rights to songs. So we have a wide variety of investments that we can receive. And this is a great time to begin talking about year-end gift planning. Before I turn it over to Glenn, I'd like to highlight a bit of our relationship with SEI. So as he said, he's been working with us 10 years. So in 2012, we opened our relationship with SEI, and we from there decided to select. We had SEI managing the long-term pool and JP Morgan managing the cash and balanced pool, and JP Morgan had custody of the investment assets. And then in 2015, we created the social impact pool with SEI. And in 2016, after an assessment with Cambridge Associates, the balanced pool and the income pool moved from JP Morgan to SEI, and SEI at that time took custody of the assets. And in 2020, the index pool was created. Glenn gave a bit of his background, but I think he was somewhat modest. Glenn has more than 25 years of experience serving institutional relationships as an outsourced CIO and portfolio manager. He's fully accountable for the services and resources provided by SEI. He has extensive nonprofit experience serving community foundations, private foundations, and the higher education market. He also works with several of SEI's corporate pension fund clients that have adopted SEI's fiduciary management solution. And prior to that, he spent 13 years in a similar role with Russell Investments, and prior to that, worked at both JP Morgan and Morgan Stanley. He has his background is extensive. He has a BS from Penn State, an MBA from Fordham. He holds a FINRA Series 7 license and a 63, and he gives of his time charitably as well. He is a member of SEI's Sustainable Investment Committee. We thank Glenn for his dedication to the foundation, and I will turn it over to him to share how we have been performing and adjusted strategies during these times.
Well, thank you very much, Erin. I really appreciate that nice introduction, and we'll certainly spend more time talking about the markets, talking more about the portfolios. And if all of you don't mind, I'm going to share my screen here, just so walking through a very brief presentation. So I think it's very interesting, of course, to be having a meeting on a day like today, recognizing that we just wrapped up 3 quarters of 2022, and probably not surprising to everyone on the call this afternoon is that it's been a very difficult year, to say the least. And so some of the things I'm going to be talking about this afternoon are, where are we with the markets, talk a little bit more about diversity, talk about the actual performance. I'm sure many of you are eager to see how things are going. Talk more about asset allocation and diversification, and then just some of our thoughts more for the long term. So of course, 2022, what have been the big highlights? Not surprising, inflation hitting a 40-year high, which doesn't seem to be lowering anytime soon. The Federal Reserve has been very active and aggressive in terms of raising interest rates, and they've made no indication of slowing that down. On the flip side, you have 10-year Treasury bonds and yields that are certainly going higher, and they've actually doubled since the start of the year. And then, of course, all of this is resulting in the stock market, entering a bear market, essentially dropping not by 10%, but at one point even more than 20% year to date. So it's certainly been a challenging year for investors. Here on the next page, you can see that this is through August 31st. To put in perspective, if I had time to update through 9/30, things would actually be even a little bit worse. I hate to say, but the point is that there's really been nowhere to hide, right? Because of all the news I just shared earlier, the equity markets, the bond markets, everything has been struggling on a year-to-date basis. There's been nowhere to hide with the exception of maybe commodities, right? We all see how much more certain services and goods cost as a result, of course, of rising commodity prices, and then cash. And we'll talk a little bit more about that in just a second. The one thing I would also point out, though, is, and there's a lot of data here on page 5, but if you went back historically and looked at the S&P 500, which is a benchmark for U.S. large company stocks here in the United States, and look at all those periods where the market went down and hit its bottom, and then eventually went back up to its peak. And so it's a way of saying, how long did each one of these periods last? What was the return experience during that peak to trough to peak? But what I would say is that if you took the average, this is going all the way back to the early 1960s, the average return has been about 11%. If you took the median of all those returns, it's been about 8.7%. So regardless of which number you use, the point is if you stay invested, stay the course, and typically that'll lead to investment success as the markets actually return to going at a higher level. And that's what you see here over the course of this entire time period. And of course, everything is not about just the stock market. It's also about the bond market. What's been happening in the bond markets. Put in perspective, the first half of this year was the worst recorded bond market experience in history. That's how difficult this year has been, not only for the stock market, but also for the bond market. So what's really interesting is as interest rates rise, typically the value of your bonds decline. But at the same token, if you're investing today, what that means is now you'll start to see higher coupons or higher yields as those bonds go forward in terms of time. So the point here is that historically, we haven't seen really high returns from the bond markets, but now with this rise in rates, we're going to start seeing the opportunity to capture more income from fixed income. Switching gears a little bit before I go into performances, diversity. Well, you heard some remarks up front by Rebecca as well as Aaron regarding, what do we look at in terms of investment managers? And so a lot of different things I can say here about investment managers, but the one thing I would say we're very keenly focused on is looking at opportunities with respect to women managers as well as minority managers. So what you can see here is currently across all the pools that SCI is managing, we're working with approximately 49 managers, and that's across all the equity and fixed income strategies. And so collectively, we have approximately 8 managers that are led by females, which represent about 27% of the foundation's assets. And from a minority standpoint, we're working with a number of managers of 19, which represents about 30% of the portfolio assets. So what I'd also highlight here too is the fact that what we've been doing over the last few years is focusing on managers that have more of a direct impact. And what I mean by that is the investments that they're making in their portfolios have some kind of social aspect tied to it. So for example, with Community Capital Management, they're a fixed income firm that focuses on looking to invest in properties, whether it's affordable housing, affordable mortgages, et cetera. And you can see here collectively, year to date for the Miami Foundation, they've invested over $1.5 million in diverse type strategies to really help the benefit of Miami and the surrounding region. And similarly, Domina is another firm that also does impact investing, whether it's through municipal bonds or other types of fixed income securities. Their goal is to focus on healthcare, education, infrastructure. And what we're doing now here in the fourth quarter is we're actually allocating a little bit more towards CCM because why? They've got a good track record. Their overall benchmark is less than the broader bond benchmark, meaning that it has less duration risk. And a lot of the work they've been doing certainly benefits this area of Miami. So talk a little about returns. Probably not surprising to everyone on the call this afternoon is that it has been a difficult year. Kind of put in perspective, through the first 8 months of this year, the S&P 500 is down more than 16%. That number is actually even worse if you factor in September. And the Bloomberg Barclays Aggregate Bond Index is down close to 11%. So think about that. You take a combination of stocks and bonds, regardless of what the mix is, you've experienced a negative rate of return year to date. And so you can look at the table there and list all the pools that Aaron described in more detail, from a long-term pool, social impact, index, balance, and income. So the range of returns varies, of course, right, because of the level of risk in each portfolio, as well as the expected returns for each of these portfolios. And so I don't want to sound too negative, because it has been a difficult period, the last 8 months, the last 12 months. But if you focus a little bit more on the longer term, the last 3 years, 5 years, 7, 10 years, you'll see that the returns are still positive, and in some cases the returns are where we want them to be, high single digits. So it's certainly been a lot more volatility in the short term, but collectively the pools have had a difficult experience so far year to date. But the focus on the positives. So here on page 9, looking at the long-term pool. So went back 25 years to get a sense for, how has this pool done over a pretty long time period, where you've got more than 2 market cycles included here. And so those little bars in front of you are showing you the absolute returns in each of the calendar years going back 25 years. If you were to take an average of those returns, it'd be about 8.7% net of fees. So I would take those returns any day of the week, recognizing that, of course, prior to this year with higher inflation, these returns have been sufficient to achieve our objectives and outpace inflation. And you can really see that in any given calendar year, there's really only one really tough one. And we all know what that was. That was 2008, because of the great financial crisis, the mortgages, et cetera. But you look at those other periods where the returns were negative, the returns were modest, especially in years like 2011 or 2015. They're practically near zero, so they weren't terrible. So you collectively look at the last 25 years, we've had positive returns in 20 out of 25 of those years. So I wish I had a crystal ball. I could tell you what's going to happen for the remainder of October, November, and December. That's why there's a question mark there. We don't know exactly how 2022 is going to shape up. But clearly, if it were to end today, it would be a negative experience. But if you look over the last 20 years, Aaron mentioned earlier talking about peer groups. So there's a pretty well-known peer group out there that's managed by the Fiscal Administrative Officers Group, otherwise known as FOG, and work that they do with a group called the Crucial Consulting Team. And they collect the returns of community foundations around the United States. And they have history going back more than 20 years. And so the returns of all those community foundations combined, which is more than 65 organizations, that return has been about 6.5% net of fees. So you compare that to this long-term pool that I believe many of you are invested in, that return, again, has been 8.7%. So we've basically have been able to outperform a broad peer group over a lengthy period of time. Talk a little bit more about asset allocation here on page 10. So you look at each of the pools combined, you probably don't see a whole lot of differences, right? There's certainly a good mix between equities and fixed income, but where the bigger differences are lying are basically one with alternatives, right? So you can see in the long-term pool and the balance pool, we have a dedicated allocation to alternatives. I'll talk a little more about that in just a second. And then, of course, with the income pool, because it's one of the more conservative options, there's a high concentration towards cash. If you kind of go one step further, I do have to apologize because my selection of color palette here is, I try to embrace a lot of the vibrance of Miami. So you'll see a lot of purples and greens and yellows, et cetera. But in all seriousness, what you're seeing here is that in some of the pools, while they all have a high level of diversification, the long-term pool especially has pretty much every asset class you can see that's listed there on the right-hand side of this page. Certainly different weights, but I'll talk more about why we do this in a second. But I want to be clear to everyone that each one of these pools does have a high degree of diversification, just that each pool utilizes different investments for different reasons. One simple example that I love to point out, and I give full credit to Julie Neitzel this afternoon for sharing this chart with me earlier, is that you look over the last 30 years, so you can see I love talking about the long term. Go back to early 1990s. Back then, it was a lot easier to achieve a return of about 7%. All you had to do was invest in cash or money markets or CDs, with a little slice towards bonds, and you would have gotten a 7% rate of return. The more important part to this story is the fact that your expected risk or your actual risk would have been about 1%. So you didn't take a whole lot of risk to get a 7% rate of return. Fast forward a little bit, how about to 2006, right? You can see here, to get that same 7% rate of return, you had to start incorporating other assets into your portfolio, US large cap stocks, international stocks, small cap stocks. But what happens there is your risk level goes up, right? Almost to 7%. Now, fast forward to this year, 2021, or even 2022, this is as of 2021, but to get that same 7% rate of return, now you need to even be more diversified, and you can see what happens. Your risk level goes even higher. So it's not to say this is a bad thing. It's just basically saying that to get certain rates of return nowadays, you need to be more diversified. And obviously, it'll be interesting to see where 2023 takes us with the rise in interest rates, and certainly seeing now that I said earlier, fixed income and cash yields moving higher. But I guess I want to leave you with a couple more slides here. The first thing I would say is, when we talk about building these different portfolios, the first thing that we look at is saying, well, what is the overall expected return of a portfolio? What are the investors that want to be in these pools? What is an ideal return target, right? Obviously, we can't guarantee returns. We can't predict returns with certainty. There's going to be a lot of volatility, a lot of variability in terms of what's happening in the economy, the global markets, et cetera. But what you can see here is that it's each one of the pools, there's a wide range of potential outcomes. And how I came up with these returns are basically saying, what are the capital market expected returns for each one of those underlying asset classes and the associated risk with each one of those. And so right in the middle, where the light green meets the light blue, we'll kind of give you an idea of where we'd expect returns to fall in any given 1 year over a 10-year period, 50% of the time, right? So you can see at the very, very bottom of the small print, they're the expected returns for each one of the pools. The good news is, with higher interest rates, is that typically with higher interest rates, you can anticipate higher returns from fixed income markets. The other thing I would say too, though, is we have a keen eye on the expected returns. Why? Because we know that inflation has been running really hot this year. And I think everyone is going to be watching, is the Fed action helping bring down inflation? But again, the key point here is that our goal is to try and get the best risk-adjusted returns. That means how much risk are you taking to get those possible returns? So really kind of to wrap things up, what I would say is that when you think about your investment strategy, when you think about which pool you're invested in, or pools, I should say, a couple of things. Everything is based on time horizons, right? Because we know that investing is a commitment like other things, right? So how do you really rise to those challenges? The second thing I would say is, really trying to figure out what are your own personal objectives and how much risk do you feel comfortable taking, right? On that previous slide, you saw that the range of outcomes varied, in some cases pretty significantly, between the pools. The third thing I would say too is that, which I just said basically, is that there is a wide range of outcomes, right? So regardless of what's happening in the markets, sometimes you have to be mindful of the fact that there is going to be a wide range of possible outcomes. And so the other thing I think is really critical right now, I've had many conversations this year with clients basically saying, should we get out of the market? Or when do we get back into the market, right? Because it's very difficult to time that, knowing that our emotional biases can kind of get in the way. You're being very concerned about what's happening in the economy right now. But the last thing, and I'm sure you've all heard this many times over, is that diversification is the key, right? If you hold a different basket of different asset classes, it's a very powerful tool for kind of helping you through challenging market environments and even in good markets. So overall, I want all of you to feel confidence in that, working closely with the investment committee, we've devised a strategic asset allocation for each pool that we do think will lead to long-term success, and just trying to be a little more patient in difficult environments like the ones that we're in right now. So with that, I will hand the reins back to Star.
Thank you so much for that, Glenn. That was a lot of information, a lot of deep knowledge that you shared with us. And really, it's something that we're all talking about, you know, whether it's around the table with our own families, with our own advisors, and really just trying to understand, you know, what is our best individual moves in our own portfolios and in our giving portfolios as well. So I think really what's been most important has been the communication that we receive, just like this briefing that we're getting today, but also the communication that we have with the folks that are the experts that are able to digest this information and really help us get a better understanding of it. I'm wondering, Delvin, is there anything that you can share with us regarding some client engagement strategies and what that's currently looking like for you and your clients that you service?
I'd be happy to, but first I'd like to say that Glenn gave us an outstanding description of what's happening in the market and the landscape of the market right now. So thank you for that, Glenn. What we're finding is that as you all know, as we all are, clients are concerned about the economy and the markets right now. The degree of concern varies from client to client. So therefore, knowing your client at this point is extremely critical, and even more so in these uncertain times. We believe that communication, as was already stated, is key. And as volatility has increased, it's been an opportunity to check in with our clients and to reassess their goals and the risks that they're willing to take to achieve their goals. Volatility and uncertainty have also presented opportunities for our clients. We're spending more and more time on cash management issues and opportunities than we have in the last 10 years. So that's how I would sum up what's going on at the client level.
That's interesting that the cash management is the #1 right now in terms of how to look at what's liquid and how to best use that liquidity, both short-term and long-term. Are you seeing something similar to that, Julie, with your clients?
Yes, Estrellita, and excellent insight, Sheldon. I think one of the most significant assets now that we all possess is patience. And I think, Glenn, you touched on it quite a bit in the presentation and in terms of really recognizing that if you're going to be an investor that has an objective to grow your assets, grow your investments over the longer time horizon, what comes with that territory is these periodic market downturns that we're experiencing right now. So really helping set the table that patience is important. As long as you have the proper asset allocation and strategy plan in place, it's really important, again, as Glenn pointed out, to be disciplined and stick with that plan, and don't let your emotions take over this important decision-making process. I think one of the other things that's been really critical is to have different types of investments that you incorporate into your investment plan. Glenn posted that really nice, colorful slide that showed, particularly in the long pool, the diversity of different strategies. That's been very important. I can remember I was the prior investment chair, so Glenn and I and the other committee members at that time looked at him and said, Glenn, why do we have this energy credit strategy in the portfolio? Because it looked pretty bleak for a couple of years there based on investment performance. And lo and behold, it's kicked in and added really important buffering value in this market environment where we see all the directional type of equities pulling back. So that alternative type of strategy allocation where you're relying on different sources of investment returns rather than just the equity or bond markets has been really valuable.
That's excellent. That's excellent share there too. When we're looking at just globally what's going on, I know that there's a lot of different stresses that's bringing into our market and really causing some of that volatility that we're seeing across all the different sectors. Is there, and this is to Bill, how are you all looking at the global issues, and how are you sort of translating that to your typical banking client?
Sure, and I think we have a little chart that we can put up here from our host, which shows the roller coaster that we've been through here. Thank you, Janelle. There we go. And we've seen many colors today. This is a different set of colors. And basically, we start off in 2020, that period that we knew so well, when everything just fell off a cliff. And it seemed as if there was no bottom to the market. Our chief investment office at Bank of America manages almost $3 trillion, and we have a very serious team that meets on a regular basis to consider these issues. We also have access to things that many other firms do not. So, for example, we touch 1 out of every 2 households in the country through various types of ways: bank accounts, credit cards, checking accounts, mortgages, maybe even our sister company, Merrill. And of course, that credit card information can be very important. Not what individuals are doing, but what's happening in the mass, to see how consumers, a very important part of the American economy, are in fact behaving. And so we were able to look into this waterfall sell-off and see what was going to happen. You can see that maroon part down toward the bottom, which we called the bridge. And this was where we had the government help. We had the beginning of liquidity being provided to households, to businesses, as well as to nonprofits. And then the beginning, as we saw, turning into 2021, the economic recovery, that blue slice there. Then things began to get a little more interesting. And Glenn, this is where I think your remarks were very relevant. This pent-up demand cycle, suddenly out of all that money that had been injected into the economy, basically to stop it falling through the bottom, it found a bottom and suddenly was flush with cash. And as we know, inflation, one easy way to define it is too much money chasing too few goods and services. And so this is what kicked off this inflationary period that we've been in now. Where we see it now is what we're calling the Great New Dawn, which really is a restructured economy. It not only reflects changes of structure in the US, we've seen things like the so-called Great Resignation, people of the baby boom generation leaving the workforce, workforce participation generally decreasing, which leads to increases in labor costs, and also sets the stage for an increase potentially in automation here in this country. But you've also seen this Great New Dawn era in other ways. This period, Glenn, in some of your charts, you look back to 2008, 2009, that was the beginning of what I would call the last regime, the last sort of set of rules, the political, economic, social set of rules that determined what was possible as an investor. And that regime was characterized by low interest rates, low inflation, increasing globalization, and it lasted until the end of last year. And now we are in a different regime, which, as you said, is characterized by completely the opposite: higher interest rates, higher inflation, perhaps increasing unemployment, decreasing globalization. And so it would be surprising, to come to your point, if the same strategies that worked in the past are going to work in the future. And this is where we call it the new frontier beginning. And we have, as you can see off to the right here, a green, a yellow, an orange, and a red dot. The yellow dot is our base case. This is what our chief investment office believes is about 50% likely to happen. Glenn, you spoke in terms of probability. So this is the same way that one thinks about this. And this is kind of a period, we're calling it a limbo period, maybe a growth recession. That would be a recession in which you have the economy still growing, but at a slower rate and subject perhaps to some corporate stress, lower corporate earnings and lower corporate dividends and so on. And that would lead to lower corporate share prices. Earnings, as I said, interest rates reset. We're seeing that happening right now. Liquidity is getting tighter. I mean, we've talked a lot about interest rates going up. One of the things that you hear on the financial news, for those of you who watch, is a thing called QT. Well, what does that stand for? Quantitative tightening, which simply means the Federal Reserve and central banks around the world are no longer going to be the purchasers of last resort of corporate bonds and government bonds. They're letting those bonds run off. In some cases, they're even selling them. And this removes money from the economy, which then potentially leads to not only a decrease in inflation, but there is some possibility of what's called deflation, an actual decrease in prices. We've seen this already. Some of the building supplies like lumber and other supplies that went way up earlier in the year, their prices have now retraced. We see it in the commodity sector, partly because of government action, but partly also because, again, of this withdrawal of money from the economy. You're seeing, for example, gasoline prices at the pump going down. So that's a 50% base case. There is a 10% woohoo kind of bull case. I don't think anybody really expects that. It would require many things to have gone right that have not necessarily gone right. But looking forward, we actually give 20% each to kind of bearish cases, an angry bear case, a grizzly bear case, in which the Fed essentially does not succeed in the goals that it sets for itself or puts its foot on the brake too fast. We heard this image earlier, and it causes a more severe recession. So at the moment, I think we are cautiously optimistic, this 50% base case, where we think there's going to be perhaps a mild recession, perhaps some flirting with deflation, but on the other side, this restructured economy in which we think there will be a potential, and you can see this reset period at the far right, what we still call, relatively speaking in equities, a secular bull market. Increased portfolio, again, diversification, many eggs in many baskets, really working in your favor. We work with higher quality exposures, not so much risky exposures. Remember, money now costs money. Money is not free anymore as it was in the previous regime. And increased exposure to alternative investments, as Glenn mentioned, the venture capital, the private equity, the commodities, the real estate, things that can be friendly to inflation, things that take you away from the liquid markets, and increased use of real assets. So here is our outlook. You can see here that it rhymes with many things that you've already heard, but I'll just sort of leave it here. This will be part of the package. And for those of you who do have questions, we can talk about those separately offline.
And Bill, can you hear me?
Hi. I can.
Hi. Listen, kudos to whoever on your end created that slide. I think it's a fantastic slide because it really has a lot of information in on this recent journey that we've gone through in the world, in the markets. I realize that the intention of it is not to chart the S&P 500 over that time period. It's really more showing the journey, but it reminds me of the slide, Glenn, that you showed about kind of the ebb and the flow of the S&P 500 over time. And at some point, we will recover. And depending on what scenario, Bill, you've set forth, we will recover and eventually regain some of the unrealized losses we've seen in the market over the last period.
Yeah, and Julie, this is important for our listeners to know. Both you and Glenn have mentioned this. Aaron, you've touched on it too. For those of you who are listening today, who are discouraged and who are contemplating selling and going to cash, don't do it. It requires that you make two very clever decisions. First of all, when to get out at the right time, and secondly, to make a decision about when to get back in. Those are very, very hard to do, even for experts, and almost no one tries to do that. I think we can all, from our previous experience as professionals, cite examples. I'll not mention the name, but there's a well-known liberal arts college here in the Northeast where I am, that in 2009, their investment committee lost its nerve. They took the whole endowment, hundreds of millions of dollars, and put it all in cash. And then they did not trust the recovery that came afterward, and they waited several years to get back in. And their endowment lost hundreds and hundreds of millions of dollars of value out of that. I mean, just a clear fiduciary failure. So it's this ability to understand what you're doing, to stick with that course, because you know that there is a world on the other side. Whether it's our happy case or our 50% base case, there's no point in trying to time the market by going to cash and then trying to get back in later on.
That's a great point, because right now when people are scared, their first reaction is kind of to pull away. But really what I've been hearing more than anything from all of you has been, look at where you're invested and think about where your spends are and how you're allocating. And perhaps maybe looking at the asset allocations as a way to sort of protect your existing investment and look for hopefully better returns or lesser losses in this type of market. So can we speak a little bit to what kind of guidance Aaron or perhaps Bill, you all are providing with how to look at amending that asset allocation across those portfolios?
Aaron, why don't you go first?
Sure. Well, what I would say is that within our asset allocation, there is a range. So we have we have a bandwidth to move within. So while we may not make a large adjustment to the asset allocation, we may be able to lean into, for example, real estate or alternatives right now, still within the framework of our investment policy, but benefiting from, as I said before, our guidance and our investment policy statement and what we're charged with as an investment committee is to have a portfolio with uncorrelated returns from various asset classes. So I would not suggest making that you're chasing the ball, right? And what Bill said, you have to be very clever to go into cash, right? So we've set up these resilient strategies for times like this. So leaning in within the parameters, yes. Completely changing an asset allocation, I would say no.
Yeah, and I would
Bill,
agree with
what's your
that,
take?
Erin. Particularly if you look at the long-term pool here, as Glenn showed us, it's profoundly diversified, right? There are many types of eggs in many types of baskets, and that is your bulwark against the unpredictable future. For those of you who are thinking about other types of portfolios that may be less well diversified, for example, in my work with colleges and universities and my work with other community foundations, where in this previous regime, you found very low inflation, you found very low interest rates, very often strategies that would have worked in a normal risk environment, such as hedge funds, didn't work very well. And you saw committees turning away from real assets. You saw committees turning away from hedge funds and saying, oh, these don't work. Why would I pay for them? Well, now you're in a different regime. And many of those are starting to work quite well. And so as I say, and active management the same way. People said, oh, all you need to do is be in an index for a dozen years. Well, that has turned out to be basically what's called a momentum investment, where you're investing in things that have gone up. Your S&P 500 index isn't really 500 stocks. It's because it's capitalization weighted. The most valuable stocks get a heavier weighting in the index. And so you're not really investing in 500 stocks, you're investing in about 20, primarily tech stocks, and the other 480 are coming along for the ride. So in this environment that we're in now, to answer your question, Stelita, we are looking not at profound changes because we always were well diversified, but leaning perhaps in a little more, as Erin was saying, to things that are perhaps more inflation friendly, because I think we all agree that we are likely to be in a world in which there are both higher interest rates and somewhat higher inflation as a norm going forward. And so in that environment, you'll want to have things like real estate, things like commodity indices, things that are more friendly, if you will, to an inflationary environment, so that at the margin, you have that exposure. It's not that you devote the whole portfolio to it, but it certainly has a place there. And we saw, for example, Glenn, in the portfolio that you described, saw small prudent amounts in all of those areas. So that's, I think, where we're looking very carefully at this. In addition, of course, to alternatives, as we've mentioned.
I think the other thing I would add to Bill and Erin, what you said, and it's something we've been very disciplined about in the long-term pool, is private equity, and remaining disciplined to legging in to different vintage years. And that is a really successful approach to private equity. So right now, private managers that are investing, they're investing at different valuations, which creates new opportunities for those investments in terms of generating attractive returns. So that's a really important component of the long-term pool.
Yeah, and Julie, what you said is very important, because we've talked about diversification among different asset classes, but you've just opened the door to a different kind of diversification. When you're looking, for example, at venture capital or private equity, it's not a one type of decision that you make one year and then you're finished. You have to build this out, and you called it vintage year diversification. A little every year, often in different types of fund, sometimes with different managers. Because these are risky investments, you want to put a little out year after year, because the investment climate will change. And because these are private funds, they're frequently locked up or semi-locked up, and you can't get your money out. So you tell me, but our experience has been it can take 9 to 10 years to create, from starting from zero, to create a prudently diversified private equity and venture capital allocation for your portfolio.
Now, I want to see if we can change a little bit of course here so that we can get a little bit of an understanding of how we could shed some positive light on this. And for maybe some of the donors that are looking to enter the market at this time, Glenn, what would you share with them to ease any weariness that they may be experiencing?
Yeah, no, thanks. That's a very good point. And I think we've all made a comment, Billy made a comment about timing. Because timing, obviously, there's that proverb, right, where it says timing is everything. As we all know, that's about many things in life. But when I think about investing, I would say the word time is everything, right? Because real simply, if your time in the market or how long you stay invested is really everything. I'm sure everyone knows that, and Bill already said this, that trying to time the market, when to get in, when to get out, it's difficult. And Bill already said this, you can't really always get that right. But when you are invested and you remain invested and you have a longer term mindset, time is typically proven out to be working out in an investor's favor. So I think where we are today is that we're going to see a lot more uncertainty like we've been seeing this year, which means that there's going to be a lot more volatility. How many more times is the Fed going to raise interest rates? How's the economy going to adjust to further Fed policy actions? Not just here in the United States, right? But it's happening around the world. There's only one country in the world right now that still has negative real yields, and that's Japan. So the point is that with higher interest rates around the globe, basically it's trying to offset this higher global inflation with the supply chain shortages. So what I would say is that, when you think about investing, think longer term. If you make your investment today or tomorrow, the point is that if you stay invested, typically time will be on your side.
Yeah, I think the great news with the types of donors and investors that typically center around the foundation is we are patient, we are in it for the long run, we are folks that are invested in Miami in general. So I think a lot of us, myself that has my fund at the foundation, I know that I feel comfort around all of these investment strategies that are in place by our leadership, but I also know that my biggest concern is just to continue to serve the community and make sure that where we are having a deficiency, we can make up that deficiency in some other way. Part of what that may look like is possibly these unrestricted gifts or these grants with less restrictions to help sort of alleviate some of the deficiencies that the nonprofits are currently facing with these monies that we may be looking to invest into the community through our donations. What are we looking at in terms of sort of motivating a new generation of donors or volunteers, seeing how this market is looking? How are we getting them to come to the table and sort of either open their wallets or give us their time?
Is that directed to me?
I saw you shaking your head over there, Bill.
I'll make this. I'll just roll this ball out, and we can have a conversation. So I mentioned I'm the editor of our study of philanthropy. That's a study of people who have at least $1 million in assets other than their house and $200,000 in annual income. So it's kind of a threshold, but the average household in our study has over 35 million in assets and over $500,000 in annual income. So think of it, for those of you who are out there on fundraising efforts or with boards, it's very much the type of major donor or transformative donor that you would want to attract. But I want to reach back here because Estrelita, you were talking about giving generally, and this is important to know. First of all, we're living in an age in which more money is coming from fewer households. The mass donation market, unfortunately or fortunately, changed more or less permanently after the global financial crisis, when average American households' balance sheets suffered, and we went from 2/3 participation, households giving to at least one charity, to less than half of what we've seen today, and that has not come back. So charities, including community foundations, are going to be looking more and more to this affluent group that I described to make those gifts. It's not as if we don't want to attract the average American household, but the fact is that they're just not participating in philanthropy as much. Now, to answer your question more specifically about volunteering and giving, one of the things that we see from the study, and this often happens with charities, for those of you who are on this call who are with a nonprofit, people will say, well, why should you give to us? And the charity will respond, oh, because we have this need. Well, unfortunately, that's not the way the donor thinks. The donors uniformly tell us that they are giving primarily because the charity or cause is aligned with their own values and is something that they're interested in. So how do you then get to a person who's a potential donor and show them that you and their values are aligned? You said it, Esther Lady, you said it, volunteering. So volunteering, to me, and I think the study shows this, is the gateway to donating. And if you are a nonprofit that has any capability at all for bringing people in, what happens is these volunteers come in and they look around and they do the volunteer activity or they take the tour, whatever it is. And as time goes by, they say, you know, not only do I like it here, I'm interested in it, and the values are aligned with what I want to express, and then they open their wallet or their checkbook. So it's not the donation comes first, it's the getting to know you part. It's this courtship that's very important. And this is the kind of strategic work that is all too seldom in need of being done, let's put it that way, in nonprofits. So I think it's important to frame it that way. Julie, sounds like you've got something to say.
Bill, can I add something? I love reading all the Bank of America studies that you do on philanthropy. And to the point you just mentioned about volunteering, in the Bank of America study, what I found really interesting is when people volunteer, they give 2 times more than those that don't.
Absolutely, absolutely. And you would have thought that volunteering would have dropped off a cliff in the pandemic, because we had almost half of the households pre-pandemic saying they volunteered with at least one nonprofit, often 3, serving on boards, ushering a church, whatever it might be. In fact, when lockdown occurred, that number did not drop to 0. It was 30%. And of course, it was virtual and so on and so forth. But a third of these people were still finding a way to volunteer. So it's a very important part of that philanthropic process.
Mm-hmm. The other interesting data point, Bill, that I read about recently is with regard to setting up donor advised funds. And this really gave me great encouragement in that 40% of millennial donors are setting up donor advised funds because they want to regularly set aside money that would be used for charitable giving purposes. And that 40% is compared to the 20% of boomers that are setting up donor advised funds that actually hold the assets. So I thought that was really, really insightful.
Yeah, it's very interesting. The wrap on the donor advised fund, people used to say, not me, but some people used to say that it was the private foundation for the middle class, very condescending way of talking about it. Well, we deal with many, many multi-generational wealthy families in our work. And also families that are building their wealth. And they may have a private foundation that's kind of the public face of their philanthropy, but each member of that family will have their own donor advised fund. And they'll be able to give impulsively, impressionistically, confidentially to what they think is important. And you're right, there is a generational shift as well in that donor advised fund. We found in the most recent study, 5% of the money given through this affluent group was coming through the private foundation, fair enough, 14%. Excuse me, I beg your pardon, 9% coming through a donor advised fund. So the numbers are moving in that way, and they're very easy to set up. So I'm not surprised at what you say.
Yeah, and that donor advised fund is a great vehicle to, work together, even just as a family. I know me and my siblings get together and decide how we want to make investments, and usually it's a conversation about passion and what are we passionate about and what do we want to help further in the community. And I think if more families and even a group of friends or businesses thought of it that way and getting around, how can we kind of put our money behind our passions, and whether that's service dollars, big dollars, it makes a big difference in the community. And you never know who you're going to inspire to become that next board member, become that next big donor, or that person that wants to leave a big legacy gift in their will. There's so many different ways to give. And I think part of the focus right now is making sure that we're doing it now more than ever. And for folks that do have a fund at the foundation, I know a lot of folks wait until the end of the year to sort of open up their wallet one last time. And, you know, why wait? Let's celebrate, you know, birthdays with giving money into our funds and supporting nonprofits that way. One of the questions that I did want to direct to Sheldon, how are you seeing some of your larger family investment folks giving and making their impact? Have they been shifting in the ways that they're looking to be impactful in these types of, in this environment?
You know, I couldn't agree more with Bill and Julie. Donors today are more than ever mission driven. And I think the pandemic has had a lot to do with that. More than ever, they're looking at ways to make an impact, looking for volunteer opportunities for themselves, their families, and in some cases, employees. I would say the corporations have become more focused on donations that can make an impact, provide volunteer opportunities consistent with their values. I believe that many donors are looking at impact and volunteering as a first step in making a financial donations decision. Perhaps that's born out of our volunteer hours served that we tracked last year with Give Today Miami. So I think it's mission driven. I think everyone that gives wants to have an impact. And the good news is that more people gave and continue to give because they had an opportunity to make an impact during the pandemic. So I think there's been a sea of change that I think is going to continue.
Yeah, I would completely agree with that. And Estrella, I wanted to come back because you asked a question earlier that's an important question about unrestricted giving versus donor restricted giving. Historically, in all the studies I've edited, about 80% of gifts, whether it be colleges, universities, charities generally, 80% were donor restricted in some way, and only 20% were unrestricted. So it's kind of gold, as it were. In the pandemic, we saw, and we drilled into this in the philanthropy study, higher ed, arts and culture, healthcare, in these sectors, you saw huge surges in unrestricted giving. Why? Because those donors understood that this was existential for the organizations. They needed to be able to have that money to spend as they saw. And then you saw the donors, the mega donors such as Mackenzie Scott and others coming in, these so-called trust-based philanthropy donors coming in and saying, well, we might examine what you do later on, but in the meantime, here's some money, do with it what you think is important for your mission because we've done our research and we have confidence in you. Early data seems to suggest that at least in the mass, donor restrictions are coming back in, but they're coming into a different mix. And I think it'll be interesting to see how this continues to develop. We're going to continue. We're going to do our study again, fielding in January. It'll be released about a year from now, a little less than a year from now. So we'll be asking these questions and see if there's any movement in that area.
Mm-hmm. I think the other thing too, Estrellita, in addition to what Sheldon and Bill shared, is I think everybody recognizes the needs are great at this time. And so to have assets sitting in an account where the needs are so great in their respective communities, they recognize that this is a time to really kind of open up the wallet and expand that giving. One of the things, Bill, that I've seen is there's a wonderful complementary relationship between private family foundations and donor advised funds.
Yes, there is, absolutely.
Yep. Right? Private foundations by IRS requirements have to distribute a certain amount each year. And sometimes families just aren't ready to commit grants at that point in time. So what they've done is create donor advised funds where they can make that annual IRS distribution requirement into a donor advised fund that really allows for thoughtful consideration on their grant making activities. So that's been a wonderful technique that I've seen out there.
Absolutely, and picking up again, Estrellita, on one thing that you kind of hinted at earlier, one thing that we're watching very carefully, and of course it was accelerated during the pandemic, is other forms of giving. So almost 2/3 during the pandemic gave through a website. So we've all kind of done that. But there are these other forms, giving through payment transfers, Zelle and things like that, text to give, crowdfunding, all of this stuff. And Small numbers, but again, Julie, to your point, disproportionately being used by millennials and next gen. So this is kind of, I won't say it's the future of philanthropy, but it's a bigger part than it would have been otherwise. And so it again bears watching, and unfortunately or fortunately, it bears investing in, so that you can receive those types of gifts if you're a nonprofit.
Mm-hmm. Yeah, and we've seen it from the foundation side, just with the growth of Give Miami Day, and just the, not only in the increased number of dollars, but in the increased number of participants here. And I think that's always a number that I look for as well, because of course we like to see the record-breaking numbers every year, but I love to see the increased number of people that are engaging and giving, even at that small entry point, because that's, you know, that's where the relationship starts and continues to be nurtured. And then we have, you know, so many more relationships and collaterals that insert themselves into the community, and it just causes that ripple effect that becomes really, really powerful. I know we actually have the last few weeks open for organizations to sign up for Give Miami Day. So I want to make sure that any of the organizations that are on here, or any of the organizations that any of you particularly support, please reach out to them and make sure that they're either already signed up, or if they do want to participate, we can get them signed up. It's one of my favorite days in the community. It makes me just so extremely proud of all of us in Miami, all of the work that the foundation does. And I know this year we're likely to hit 1,000 organizations, and it's just huge. It's a phenomenal resource also. If you're looking to find an organization to give to, it's very easy to also use that as a reference and a resource. I know I've used that as well for my office, and I've asked my employees to look through it to select organizations that we might be wanting to give to with our monthly pools that we give. So it's always a great time of year to see all that energy. And I know this year,
right,
also going to have volunteer hours as well that are going to be counted on. So Bill, did you want to interject on something there?
I do. I'm looking at a sheet that we have. So we have, like you, promotion of volunteering and giving. And of course, like many companies, we match gifts. So in the last 5 years, our employees, this is not the bank, employees out of their own pockets have given 1.1 million in Miami to Miami-related nonprofits and have volunteered 53,000 hours. So this is, we're right in line with what you're doing, and can only endorse it.
That's phenomenal. And again, you all are a ginormous beacon in the community, but I also want the small folks that are just, you know, the mom and pop businesses to make it important to them as well. And, you know, we see it when I go volunteer, I meet all sorts of people from, you know, all walks of life. And it's probably my favorite days of the week at sometimes. And really, what's most important about it is you really get to meet people that share your same values and align with your passion. And I think that's where we start to really build that sense of community and get brought back in and around the cause to be able to continue that pattern of giving with them and engagement. So I wanted to just see if anybody had some final thoughts to share, or if anybody wanted to give a particular story of one of the transitions with a client, or share a sort of success story in transitioning someone to the giving path that may not have been there as of late.
I just have some general thoughts, Estrellita, that I wanted to share. And number one, I think we heard from Bill's Bank of America study, volunteer, right? There's so many needs that volunteering is a really powerful way to connect you with maybe what's important to you, or even to just learn about what the needs are in a community. And we've seen in Bill's study that volunteering is financially very powerful, because it will lead to significant giving. Giving in the community where you live, one of the strong supporters of the Miami Foundation regularly says, give while you're living. You know, your legacy, yes, you know, is something that you as an individual and family value. But if you can give while you're living, you're going to see the impact. that you can have in the community with your philanthropy. Also give where you live. Same kind of concept, which is you'll see how you can have tremendous impact in supporting some of the key needs that your community has. And we have seen this with the amazing philanthropy of many of our Miami-based donors. The other thought that I wanted to share, and this is kind of more like a personal strategy and a strategy that some of my clients employ. Glenn has taken us through kind of the doldrums of the financial markets in 2022, and obviously we all see it reflected in our statements. Well, one way to think about maybe counterbalancing that is with your new cash. Okay, you can use fresh cash to do one of two things. Meet maybe the grants that you want to deliver this year and allow your assets to kind of continue to be invested and roll through, hopefully, the bull case, Bill, that you presented so that the market recovery happens quicker. So that's one thought. Or you can add new cash into your investment portfolio and take advantage of something that is kind of a comical thing that I saw, which was a headline for an article saying, stocks are on sale. And what they did is they left off the T, right? So meaning you can put some fresh cash to work at these depressed market levels. What do you think of that?
I don't have much to
Great
I don't have
point.
much to add to that, Julie, except to say that one of the key findings of the philanthropy study is that being philanthropic makes people happy. And so it is not only something that's good for your community, it's something that's good for you. I'm not a doctor, but it might end up lowering your blood pressure. It might end up lengthening your life. It might end up giving you better relations with your family and your neighbors. So it's something to do. And just again, coming back, I was just noting again on our fact sheet here, in addition to the employee giving, we have a program that I think you may know called Neighborhood Builders, which exists throughout the country, where we go to nonprofits and support them. And the two in the Miami-Dade area that we're working with are the Arts Center and a group called Gang Alternative. So there's room to do good everywhere. And you don't have to be huge to do it. So that's I think where I would leave this.
And Sheldon, from where you sit, I know you have a vast, decades-long view of all the wonderful giving that has happened in this community.
True. And what I always say is, with every major donation, with everything that we accomplish, the need seems to grow more. This really is a community with deep needs. So there's always going to be ways and opportunities to help out in Miami. The needs are infinite here. As prosperous as a community like Miami is, the needs are incredibly.
Aaron, did you have any closing? Aaron, did you have any closing comments that you'd like to share with the group from your perspective?
My closing comments are, we are here. We are here to serve you and to serve the community. And please reach out at any time if there was something one of us mentioned today that you'd like to drill down on more. Give us a call. If you'd like to know more about our investment policy statements or the work we do as an investment committee, we're here.
Thank you for that. And I'm actually getting the last few questions that are coming in from the audience. So if anybody else has another question, we could still cover. I just got one more for Glenn. Glenn, this question is to you, and they're asking regarding your experience overseeing other community foundation assets. Can you share some of the thoughts on what you recommend to them in these particular times?
Okay. Yeah, no, it's a good question. Well, I think the first thing I would say is that what's been really interesting, it's been a great dialogue with everyone this afternoon. And what's great about technology, if you think about over the last 2 years, how we're all communicating today, right, in a virtual setting. So what I've really noticed is that clients have really stepped up the amount of communication with one another, including with their partners. Just wanting to get a pulse of what's going on in the markets, what's going on in their particular communities, what's happening with the investments. And so, I think what I would say is just some closing, takeaways are, we talked a little bit earlier about alternatives. Julie highlighted one of the energy investments that we had, which we're now been liquidating this year, made the foundation a lot of money over the last few years with respect to that investment. And now this year, we're currently exploring other alternative investments, certainly for longer term horizon, like venture and other private deals. But a lot of times when the markets go down like this, we all know that it opens up the opportunities for some distressed investments. So that's what we're watching pretty closely now with a lot of our client base. I would also say that I know that there might be some audience members today that sit on other boards or other committees and want to get a sense for what they're doing at their organizations. Spend rates are always a very hot topic. Are you maintaining your spend rates, reducing them, increasing them? And so certainly, obviously, it ties back to what your short-term and intermediate and long-term goals are. So I spent a lot of time the last couple of years revisiting investment policies, resetting or reaffirming, goals and objectives. What's also really interesting is I know we keep saying, buy into these dips, so to speak. Stocks are on sale, as Julie noted. But what I would also say is that we've had some clients been very mindful of, thinking about there could be, more pain to come over the next couple of quarters. So earlier this year, we set aside very modest amounts in cash and other short-term liquid investments just to kind of cover us through this difficult period here in 2022. So it's not to say that we're worried and we're moving all into cash, just having a little bit there, more for an opportunity. But as you heard me say earlier, I guess my last comment would be, just staying diversified, staying the course, making your investments, sticking with your long-term objective, because as we've seen in the past, taking steps, Bill gave a great example before, making irrational or bad fiduciary decisions could lead to bad outcomes. So you're better off staying the course, staying diversified, and you see over time that you're usually handsomely rewarded for that.
Staying the course and being vigilant is truly important. We only need to look back to March of 2020 when we thought the world had come to an end. And within a quarter, we were back and above where we started. So there's some lessons to be learned here.
Great.
Incredible. I think this has been really productive, really insightful, and just really transparent. And I think communication is really what the foundation is focused around, and being able to share this type of information with our partners, our funders, and those who support our organization is really important. And I thank all of you for participating today, all of our panel members, the folks from the foundation that helped put this together, and all of our participants. I'm hoping that everybody got some great information from here today, and that our next investment briefing, we have some greater information to report, but also some great numbers and some great engagement to report as well. I'm looking forward to our Give Miami Day that's coming. So please, please, please remember and plan to make some great gifts from your funds then too. And absolutely stay in touch with the team over at the foundation. If you do have any questions about today's presentation, you could reach out to the foundation at philanthropy@miamifoundation.org and get any of your questions answered. With that, I will close today's presentation. Thank you again for attending on behalf of myself and the Miami Foundation. Thank you once again for trusting us with your investments, and we will be here for you today, tomorrow, and far into the future. Thank you very much.
Thank you all.